97% of the dollar's purchasing power was not lost during civil wars or foundational crises, but instead eroded under the last 20 presidents, steadily consumed until reaching the 0.03 of parity observed today. From the founding of the financial system by Washington to the volatility under Trump, each administration left a unique fingerprint on macroeconomic graphs. This video technically analyzes the economic performance of the 10 most influential presidents in history, separating political reputation from mathematical reality. Donald Trump assumed the presidency in January 2017, inheriting an economy in a mature expansionary cycle from Obama. The unemployment rate stood at 4.7%, with a downward trend established over the previous 7 years. The capital market was operating near historical highs, driven by low interest rates. The administration's economic strategy was based on two pillars: sectoral deregulation and aggressive tax cuts. The centerpiece was the Tax Cuts and Jobs Act of 2017, which reduced the corporate tax rate from 35% to 21%. Although the measure stimulated the S&P 500 and private investment in the short term, it widened the fiscal deficit during a period of economic growth. In 2020, the economy faced the exogenous shock of the COVID-19 pandemic. The forced shutdown of activities resulted in the most abrupt contraction in recorded history. In April of that year, the unemployment rate jumped sharply to 14.7%, wiping out the employment gains of the previous decade in just 1 month. In the end, Trump was the only president in 90 years to leave office with fewer jobs than when he entered. Trump left office with unemployment reduced to 6.3%. However, with public debt expanding by approximately $28 trillion and the first signs of inflationary pressure in the supply chain, the administration is characterized by high volatility. Although he presided over historically low pre-pandemic unemployment rates of 3.5%, the structural fiscal fragility created by tax cuts is a major factor. This limited the state's room for maneuver, resulting in the largest expansion of debt in relative peacetime. Barack Obama took office at the epicenter of the Great Recession, which had previously seen a drop of -8% in GDP. In January 2009, the economy was contracting at an annualized rate of over 6%, as can be seen in this graph. The banking system was facing insolvency, signaling a collapse in interbank confidence. And the private sector, according to this graph, lost 800,000 jobs in a single month. The immediate response involved the American Recovery and Reinvestment Act, an $831 billion fiscal stimulus, and the Dodd-Frank financial reform aimed at increasing capital demands for banks. Simultaneously, the Federal Reserve initiated quantitative easing, expanding the central bank's balance sheet to buy toxic assets and lowering interest rates, increasing the money supply to stimulate lending, investment, and other economic activity. These measures prevented a second Great Depression, stabilizing the financial sector and the automotive industry. However, the recovery of the real economy was notoriously slow. GDP growth remained tepid, averaging around 2% annually, characterizing what economists have called secular stagnation. And this labor force participation rate shows exactly that. The search for employment has fallen over 8 years. Upon leaving the White House, Obama handed over a stable economy, with the federal deficit reduced from 9.8% of GDP in 2009 to 3.1% in 2016, and a record-breaking 75-month streak of job creation. However, the labor force participation rate fell significantly, indicating that many Americans have given up looking for work or have retired early. The management stands out for its effectiveness in crisis management, reversing a systemic financial collapse. However, the lack of dynamism in GDP growth and the increase in nominal debt of almost $10 trillion, reaching a total of $20 trillion, prevent a higher ranking in terms of prosperity generated. George W. Bush assumed the presidency in January 2001 with a rare fiscal scenario, an inherited federal budget surplus of $128 billion. However, the capital markets were already showing signs of cooling after the bursting of the dot-com bubble. The administration implemented aggressive tax cuts in 2001 and 2003, aiming to stimulate consumption. As a result, public debt rose exorbitantly from this period onward, since tax collection was no longer as high as before. This caused the debt to more than double, increasing from an initial $5 trillion to $12 trillion by the end of his term. Simultaneously, government spending expanded dramatically due to the wars in the Middle East, particularly the Iraq War. This combination converted the structural surplus into immediate fiscal deficits. In the private sector, the ownership society policy, coupled with interest rates kept artificially low by the Federal Reserve, falling from 6% to 1%, encouraging the population to take out loans, inflated the housing market. The Case-Shiller Index, the main metric for home prices, has become disconnected from economic reality, rising more than 80% in 5 years. When the bubble burst in 2007, the value of assets collapsed. The mortgage default rate jumped to 11.3%, exposing the fragility of financial derivatives, once again the highest in history. The result was the 2008 global financial crisis, where the S&P 500 index suffered a 57% devaluation from top to bottom, destroying trillions in market capitalization. Bush left office amid the worst recession since 1929. The initial surplus turned into a record deficit of $1.4 trillion. His administration occupies a critical position in the rankings due to structural fiscal deterioration and regulatory failures that allowed excessive leverage in the banking system. Bill Clinton took office after a technical recession in 1993. The unemployment rate was high at 7.3%, and the fiscal deficit was a central concern for Congress. Economic policy focused on fiscal discipline and trade liberalization, marked by the signing of NAFTA. In 1993, increased taxes on the wealthiest and spending cuts, combined with the productivity boom brought about by the internet, generated a virtuous cycle of revenue collection. Clinton turned historic deficits into record surpluses. The macroeconomic result was a historic anomaly: 4 consecutive years of federal budget surplus. Clinton handed over the country at the height of an economic expansion, with average GDP growth of 4% per year and controlled inflation. He left the country with controlled inflation and unemployment at historic lows, below 4%. Despite the bursting of the dot-com bubble in the final months of his term, the fiscal data place this administration as the most mathematically efficient of the modern era. Reagan took office facing stagflation. In 1980, inflation, measured by the CPI, peaked at 14.8%, eroding purchasing power. While unemployment remained stagnant at 7.5%, confidence in the dollar was at historic lows. The response was twofold. On the monetary front, the Fed chairman, Paul Volcker, raised the benchmark interest rate to levels above 19%, deliberately stifling the economy to kill inflation. On the fiscal front, Reagan implemented supply-side economics, massively cutting taxes. GDP responded strongly, growing 7.2% that year. However, the cost was an explosion of debt. The combination of lower taxes and record military spending tripled the nominal national debt. Reagan left office with the economy growing and inflation under control, restoring confidence in American capitalism. However, he reversed the historical trend of deleveraging. The public debt as a percentage of GDP, which had been falling since World War II, began to rise consistently again, ushering in the modern era of structural deficits. Richard Nixon took office in 1969 with an overheated economy. Inflation, historically stable below 2%, had already broken the 4% barrier, driven by the social spending of the previous administration and the Vietnam War. The central problem, however, was the depletion of American gold reserves. On August 15, 1971, the administration implemented the Nixon shock. The administration unilaterally suspended the direct convertibility of the dollar into gold, ending the Bretton Woods system. The dollar became a purely fiat currency, without physical backing, allowing the Federal Reserve to expand the money supply without restrictions. The measure generated short-term euphoria, securing his re-election in 1972. However, the artificial suppression of prices failed. In 1974, inflation reached 11%, while unemployment rose to 5.6%, ushering in stagflation, a phenomenon of stagnant growth with high prices that defied prevailing economic theory. When he resigned in 1974, Nixon left behind a structurally altered economy. The purchasing power of the dollar began its steepest decline in history, losing half its value in the following decade. FDR took office at the depths of the Great Depression, with GDP collapsed by half. The New Deal and entry into World War II brought unemployment to a standstill. but at the cost of raising the public debt to a record high of 119% of GDP, defining the modern model of state intervention. At the beginning of the century, monopolies like Standard Oil controlled 90% of the market. Teddy used antitrust law aggressively to break up conglomerates, sacrificing short-term stock market stability to ensure long-term price competition. To finance the Civil War, Lincoln broke with orthodoxy and printed greenbacks, unbacked paper money. The measure saved the Union, but doubled prices in the North, generating an inflationary peak of 80% during the conflict. It all started here. Washington inherited war debts negotiated at pennies. By federally assuming these debts and paying them off in full, it created the American sovereign credit, the mathematical basis for all the graphs presented earlier. Analysis of the data reveals clear patterns. The gold standard era dominated price stability, while post-crisis administrations, such as those of FDR and Reagan, led in job recovery. However, the modern anomaly is evident. Recent administrations share a trend of exponential leverage, trading modest growth for record debt. If economic history serves as a guide, the mathematics of debt is unforgiving. The question is not if there will be a correction, but when.